By not paying yourself as a limited liability company correctly, you are constantly losing money. So make sure you stay tuned until the end because I'm going to show you the best way to pay yourself as an LLC. So what is an LLC? The LLC provides you as the member or manager liability protection by separating your personal assets from your business assets. So when you create your LLC, you are telling everyone that you and your business is not the same person. So for example, if your company is sued, the liability protection that your LLC provides will keep your personal assets separated from your business assets. They only have access to get your business assets, things like your business or your business vehicle, or maybe you have a property that's in your business name. You personally can't be held liable for your business debts and liabilities of your business. This is why you have the limited liability company in place. So you have a single member LLC, which is one owner that is called a member, a sole member, and then you have a multi-member LLC. This is if you have a partner in your business, you will be considered a multi-member LLC. Most entrepreneurs do not understand that the IRS considers your single member LLC as a disregarded entity. This means that the IRS ignores your LLC as a separate tax-paying entity. So essentially, you are telling the IRS that you're going to let the member, which is you, pay the taxes for your limited liability company. This is how your income and expenses passes through your personal tax return. So if you are a single member LLC, you must file your business and personal taxes together and not separate. Something to remember, if you are a multi-member LLC, you file a partnership tax return. You're going to receive a K-1. This K-1 must be passed through your personal tax return as well. Please do not forget this. So how do you pay yourself as an LLC? Well, you do this by taking an owner's draw. This allows you to take profits from the business and directly pay yourself. So in order for you as a business owner to understand how you should pay yourself as a limited liability company, you first need to understand how to set up an LLC. Setting up your LLC can seem very complicated, but Corpnet makes the process very simple. Their platform is very user-friendly and streamlines the entire process from the name availability check to filing the articles of organization, incorporation, or formation if you are a C Corp or an S Corp. Corpnet also offers reliable registered agent services, customizable operating agreements, FinCEN reporting, and obtaining your EIN, all at a very affordable and transparent price. You can have your LLC set up within 24 to 48 hours. You can click the link below to set up your entity. So now that you have your entity set up, you now can open up your business bank account with your EIN, which is what you're going to use to pay yourself. There are so many times that as an entrepreneur, you don't realize that by you mixing your personal with your business income and expenses, you are actually considered to be co-mingling. This defeats the purpose of setting up your limited liability company because what you have now done is affected your liability protection. For example, if you are a real estate investor with a long-term rental property and that rental property is in your LLC and you accept the rent from your tenants in your personal bank account, you are considered to be co-mingling. And if John decides to sue you because you have been mixing your personal income expenses with your business income expenses, he can get access to your personal assets like your primary residence, your cars, or even other properties that you own that may be within your LLC. You must remember that if you commingle, there are consequences behind this. You can lose your liability protection, you can trigger audits, or you can get potential penalties depending on your jurisdiction. So how do you pay yourself as an LLC? You will first take the profits that you made from your business bank account and transfer it to your personal bank account and label it in the memo section as owner's draw or owner's compensation or owner's distribution. Either one is fine. An owner's draw is the legal way for you as the business owner to take profits from your company and use for personal use. This is the biggest problem that I see with entrepreneurs. Many of them who are a single member LLC or a multi-member LLC ends up putting themselves on payroll. meaning they're putting themselves on a salary, which is a huge no-no. This is the biggest mistake that I have come across. This is not standard practice, and this should not be done. If you are a single member LLC or a multi-member LLC, you should not be on a salary where you will end up issuing yourself a W-2 at the end of the year. So keep in mind that a salary is when you pay yourself a set amount of money every pay period. You determine your reasonable compensation and the business gives you a paycheck. Now, if you elect to be taxed as an S Corp or a C Corp, then this will be the proper way that you would pay yourself. So let's dial back just a little bit. When your business turns a profit, you decide what percentage you're going to pay yourself. You have to remember that you being a single member LLC, you're automatically set up to pay self-employment taxes, which is 15.3%. and your ordinary income taxes. We still have to consider your operating expenses for things that you have in order to run your business. These are things like your monthly bills. You may pay for advertising or software costs. Then we have to make sure that we are setting funds aside for your business in case of an emergency. Or you may have a bad few months and you want to make sure that you're set up to be able to handle those few months. So once you have done this, you can now pay yourself. Now remember, the only way to truly understand this concept is you first have to understand and know what your books are. You should be keeping up with your bookkeeping so that you can know how your business is actually operating. For example, consider John. He's a single member LLC that just received $5,000 in rent from his tenants. Now he's very eager to pay himself, but he first understands that he must pay bills first. First up, there's the 15.3% of self-employment taxes that he must pay the IRS. Next, his ordinary taxes comes into play, and this is 22%. Then he has those unavoidable operating expenses to keep his business running, which is another 20%. And let's not forget about the future. He needs to set aside 10% of his earnings to his savings. I always recommend saving 10% of your profits in a separate bank account. By John doing this way, this ensures his business is actually set up for success. Now, the last allocation that he wants to make is to set aside his funds for his owner's draw. We will determine this percentage after we have paid the bills. So when we add this up, he has 15.3% in self-employment taxes. He has 22% in ordinary taxes that he has to pay. He then has another 20% in operating expenses, not to mention the 10% in savings that he has to set to the side. So that totals 77.3%. This is what he must pay first. So 77.3% of the $5,000 that he initially made in profits is actually $3,865. So remember, John got $5,000 in profits. So we're going to take 77.3% of that $5,000, which is $3,865, and this is going to pay our self-employment taxes, ordinary taxes, savings, and our operating expenses. So what's left over is what we're going to use for our owner's compensation. So he has 22.7%, which is left of what he can actually pay himself. Now, he can actually decide to pay himself the full percentage or just a portion of it. If he decides to pay himself the full 22.7%, that is actually $1,135 that he can transfer from his business bank account to his personal bank account. And then he can take the funds and use it for his personal use. So in his tax account that he has separate for his business taxes, his self-employment taxes, and his ordinary taxes, he's going to put $1,865 into this separate account. In his operating account, he's going to put $1,000 because he had 20% of operating expenses, and 20% of $5,000 is $1,000. In his savings account, he's going to put $500 because that's 10% of his $5,000. And then he's going to take the additional 22.7% and pay himself, which is $1,135. By John choosing this payment strategy, he is actually setting himself up for long-term success and a solid foundation, because he understands that business is a marathon and not a sprint. Now, this is just an example, and this is not your business. Your business numbers could be different, they could be higher or lower. This is just an example for you so that you can know what to mimic as a business owner when you're trying to figure out how you should pay yourself. So in order for you to implement this strategy effectively, you must maintain accurate records. That means you must have your bookkeeping in place and in order. It is very crucial. Bookkeeping is the engine to running your business. So in order for you as an entrepreneur to understand how to navigate successfully from point A to point C, you first must understand the steps you took from point A to get to point B. So you learn what is an LLC, how to set up an LLC, why you should not commingle, and how to pay yourself. I can guarantee you that if you follow these steps, this will put your business on the right track to be a successful business. If you found any value in this video, let me know in the comments and tell me if you think this concept can work for you. If you would like to learn more, check out our videos above, like, comment, and subscribe. From Everlife Accounting Group, my name is Karina, and thank you for tuning in to another episode of Financial Sense.